What's up, Gould Miners? Today we welcome Shifra Ansonoff to the show. Shifra is the global head of customer experience at Preqin, the leading data solutions provider in alternative investments. Shifra herself is known throughout the industry as the Obi-Wan of data, and today we go deep into the labyrinth of alternative investments. We kickstart the episode by discussing the data analytics at Preqin and how they gather and analyze data to measure fund performance as well as asset performance. From the outside looking in, it might seem that alternative investments are like the wild, wild west, but Preqin has created a very diligent process by which they can gather a ton of data and help bring a ton of clarity on asset and fund performance. Later on in the episode, we really dive deep into alternative investments and discuss the emerging trends in alternative investing for 2025 and beyond. And then finally, we conclude the episode by discussing some of the real estate asset classes that Shifra is bullish on for 2025 and beyond. Shifra helps eliminate a lot of the mystery around alternatives and provides a very logical, concrete, and holistic approach to investing that aims to, as she put it, create longevity in your investing journey. All of you investing Padawans out there, get ready to get schooled by the Jedi Master herself, Shifra Ansonoff.
The Gould Mine Podcast.
Shifra, welcome to the Gould Mine.
Thanks. Happy to be here.
Yeah, this is exciting. Your background and the things that you've been able to do throughout your career, I think lends itself really nicely to this audience in a slightly different way, coming from an analyst perspective, right? And having that background. So why don't we start? Because I'm sure that a lot of folks at home are probably wondering, okay, like, what is Preqin? How is Shifra, what makes Shifra qualified to talk about investments? So I would love to start there because I know how much of a badass you are, but I think everyone needs to hear it for themselves. So let's start with what is Preqin and what is your role there, and then we can go from there.
Absolutely. Preqin has been in the business for several decades, and we're the leading provider of alternative assets, data, and insights. So when we talk about alternatives, we're talking about all private capital asset classes, whether they be private equity, venture, private real estate, private credit, as well as infrastructure and hedge funds. And we entered the market several decades ago when our founder, Mark O'Hare, this is actually a fun little story for your audience, he attended a conference on private markets, and the MC had asked the audience, will the top quartile manager please stand up? And everyone rose to their seat. And it was then that he realized there's clearly a market for Preqin. So actually our roots, we pioneered the use of Freedom of Information Act to gather information on alternative vehicles, because public pension funds, for instance, they will file and you can publicly get documents about the funds that they're investing in and the returns. And we've since expanded to all jurisdictions and all institution types. So we actually have 500 researchers across the globe with the goal of gathering information on all of these vehicles through public filings, but also through direct conversations. So they actually call fund managers and investors and service providers on a cadence to learn more. What are some new strategies you're bringing to market? And I think of Preqin, it's sort of like a Tinder between fund managers and allocators, how they can find each other on the platform. If you're looking to invest, you can use our platform to find funds that you might be interested in. You could see track records, performance histories, a lot of information about the people who work at and lead these funds, and vice versa. As a fund manager, you can actually find investors, what they're looking to invest in, if they've expressed so, what sectors, what's their ESG criteria. So it's really, really interesting. It's an opaque market, but we've really added a great deal of transparency to the market through the data that we collect.
Yeah, that's amazing. And I'm 500 panelists.
500, yes. It's a crazy number. It might even be
Holy
higher
cow.
at this point. And they're all over the world, because when you are calling up an investor or fund manager, having that local knowledge and that experience and being able to connect, and how you connect may be different by region. There are cultural differences in how we might engage. Some folks love to go for coffee and they'll go to a coffee shop if you're in Sydney, Australia, and they'll talk to us there, in person. It really does depend. So we really are nuanced in our approach, and it's really helped us. Actually, we just won the King's Award for our data. The Majesty presented the award to our CEO, Christoph, and there's a nice picture I have to send you. But effectively, it's the highest honor in British businesses. It's a British headquartered company.
That's incredible. So I guess the first question that pops into my head, right, because when I think alts, right, and we'll use alts as well, I'm actually interested, before we even go there, define alternatives for me, because I feel like everyone has a different definition of this. In fact, I just had another gentleman on, Andy, and I was, everyone has a different definition. So what is your definition, Shifra, of alternative investments?
So they're non-traditional investments.
Mm-hmm.
They don't trade on exchanges. Mm-hmm. And if we were to look at, say, private real estate and compare it, for instance, they don't offer the same level of liquidity as, say, public real estate. So one would expect higher returns. There's what's called an illiquidity premium. And you're in these long closed-end fund vehicles. The private real estate market, as we're going to be focused on, is not traded on the exchanges, and it's a direct investment in specific properties, whether they be commercial, residential, land development, and they generate the profits through rental income and value appreciation over time. So unlike a publicly listed REIT that trades on exchange, you're also focusing on long-term goals for your property growth. You're not, yes, we're going to care about interest rates, and we saw the backup the last few weeks, but you are thinking about things for the long haul. And not just, whereas REITs, you're looking at short-term quarterly earnings and you're facing that volatility risk on a short-term basis. So they're non-traditional investments. You're in it for the long haul. You need to be an accredited investor to invest. There's a certain minimum of assets and salary that you need to have to qualify as an individual investor. Mostly the institutional market has been investing. But with alternatives, actually, was really interesting. Larry Fink mentioned on the earnings call, alternatives at some point won't be alternatives. We're going to have to find another name for them. Because and maybe it's private market investment, because, the reality is there is this effort. There are all these tailwinds where more and more individual investors are paying close attention. They're seeing the type of returns you can get through this avenue, and it's no longer the 60-40 portfolio mix. It's also, you're looking at what slice of my portfolio should I allocate to alts. I think you did ask a little bit about my background, and I didn't answer the question.
I was going to get there eventually. Yeah.
Yeah. But if you want, I could touch on that, because I went right in. So my entire career has been in financial technology.
Yeah.
I've worked at Bloomberg in my early years on the data side. Actually, most of my career has been in data. And then BlackRock on the solution side, supporting the front, middle, and back office of the Aladdin trading system, which is used by BlackRock and many asset managers and institutions worldwide. And then after that, I moved into a role on the analytics side for Axioma, which provides risk models. Portfolio optimization modeling is now under the umbrella of SimCorp. And within the last 4 years, I shifted it to alternatives, to Preqin. And initially, I was leading the global research organization, the teams that actually collect the data over the phone by direct engagements. And I run the customer experience now. So we have 200,000 subscribers who utilize our information globally. And it's my remit to make sure that they're getting the value out of Preqin.
Love it. And I think now is a great time to ask this question, because obviously you're on the data gathering and data analysis side of things. But when I think of alternatives, I think of the wild, wild west, right? And so it almost seems like it almost seems illogical that you could have as much data as you do for such a broad, kind of like loosey-goosey kind of investment umbrella. So Walk me through how we got to this point, and you did touch on it too, right? Like there was the the
Freedom of Information
Freedom
Act.
of Information. Yes,
Yeah.
thank you. That helped. What's gotten us to a point where you now have the ability to keep 500 analysts employed, looking at all this data and kind of putting it and all together. So what got us to this point?
Yeah, I think, certainly there's a lot of documentation that is out there.
Yeah.
And for a fund manager, they are incentivized, especially to have their information on our platform, because that's how they can get additional investors when they're capital raising. It's actually beneficial. But there are a host of documents out there and public information. We look at news sources. There are about 150 different news sources that we track, millions of articles a day we capture through our machine learning AI capabilities. We're also looking at any filing, whether it's also SEC filings, Form ADVs, any type of registry that would have any type of information on an entity in this space.
Yeah.
But also building our brands, through the years. We were the first mover advantage, so to speak, and we'd been able to build that reputation in the market where people will take our calls. It was very hard in the beginning, of course, as we were first building out our data set. And I remember even 4 years ago when I started, the level of introduction that we would give, when we would call a firm. Now, I know Preqin.
Yeah.
So the name has gotten out. So we comb through lots of documents, and there are certainly humans involved. We do have machine learning and AI, and this process where we're looking to extract as much information. But AI is not as far yet where it needs to be in terms of the ability to extract structured data from unstructured documents.
Yep.
It will be commoditized. So we will get there from a technology standpoint, but at the end of the day, you need a powerhouse. You need data to train the models. And that's what we've acquired. So through hard work and persistence and really getting our name out there, going through the documents, the capital statements, any type of document that we could get our hands on, we'll ask for documents. A lot of fund managers will just send us here's our document. We have templates where they can submit their returns. And then on the investor side, some of it is also publicly available, right? If you want to get CalPERS and CalSTRS, all of those documents and filings, but we'll ask for that information as well. So I think the reputation plus all of the hard work on the outreach has really helped us get here.
So from a reporting standpoint, what typically, what data points are you tracking?
Absolutely. So for a fund, we're looking at the returns. Okay. So, for sure, target close. So we'll ask the fund manager, what is the target that you're looking to hit? And that way what have been the commitments to date if we can't get our hands on a filing. Mm-hmm. We'll also find out information about the strategy and who are the people that work at the fund and what's their contact information. So we actually have contact data as well. And where they are in the process of fundraising. Are they in their first close? Are they still open to fundraising? Or, are they closed? And all of that information is quite relevant. We also have an extensive universe of private company data. Okay. So when you're a fund manager, once you reach your target close, you need to invest the money. So how do you do that? So we have 380,000 sponsored back portfolio companies on our platform with financials where we can get them, because for private companies, not all registries require you to file. Like in North America, we'd have to ask the company to share it if it's a private company. But other registries will have a filing mechanism, and we can get that. So we have employee history, growth of employees over time, which is also a wonderful proxy for evaluating a company. So what we do have is we have investment teams who use our information to do market mapping to understand, okay, this is my fund. These are what companies can I invest in? What companies might be ripe for buyouts if I'm a private equity firm. So things of that nature, you can use this information to help make your decision. On the allocator front, what kind of information we have? We have which asset classes they invest in historically, what have they invested in, and how have those allocations changed over time?
Yep.
Where they're located, what type of investor, what their average ticket size was. And by looking at what they've invested in the past, you as a fund manager can know, oh, wow, this particular investor, they prioritize a minority-led firm. Maybe I should reach out to them if I, fit that criteria. So all of that type of data that is really, really important and good signals for folks in the industry to operate is very helpful.
So what it sounds like is there's two main functions of this from what I'm hearing. So Preqin's core function, or one of their core functions, is measuring and tracking fund performance. Right. So like, how are these fund managers doing? What are the returns like, that sort of thing. And then at the same time, it sounds like when you're digging into the fund performance, you're also digging into the asset performance as well, right? Whether that be the real estate that they hold or the businesses that they're invested into, et cetera. And so in doing so, you're able to track not just fund performance, right? Matching funds with investors and so on and so forth, but also measure the performance of certain asset classes over time.
Yeah.
Which am I getting that more or less correct? Okay, cool.
Absolutely.
So then, since you have access to all this data, I'm assuming that like you are able to forecast trends over time, right? Like you're able to forecast. And so let's look back a little bit, right? Over the last 5 years, what things have you been able to things that have happened that you've been able to forecast, and things that you thought were going to happen that didn't? Maybe one of each, right? Just because. Yeah.
Absolutely. That's an excellent question. Just to give a little context of how we do projections, because that will influence the answer. We look at recent history and far history. We take all of that data, what happened in the markets, and we combine it with economic variables, and we weight the more recent history more heavily. And then on that basis, we project, where do we see fundraising over the next 6 years? Where are returns? So clearly in 2021, we had a real heyday. The markets were going crazy. We had an amazing year of fundraising. I remember the last quarter of the year, real estate had a real boon, the private real estate markets. And because the conditions were so strong, when we did our projections, we projected similar bullishness. But then 2022 happened, right? And the war with Russia and Ukraine, and then the hikes of interest rates. Those were things we obviously couldn't predict. So we were too aggressive in our forecasts, and we realized that we had to dampen them. So that's for all asset classes, actually. And we didn't anticipate as much, and we didn't anticipate private credit was going to be such a big deal as well, because we saw 2022 and 2023 were pretty good years for private credit. Levels have dampened since then, but it's still pretty strong. So yes, we could not predict with all these short-term moves what was going to happen, the Mideast crisis. So we're going to be, and this year we have our predictions, and they might be too conservative. We are actually, at this point in time, we measure the total AUM for alternatives is 16.8 trillion. That's a massive number. Now, when you think about it, when we started in 2003, it was about 400 or 500 billion. So we're at 16.8 trillion today. We're expecting that to grow by a CAGR of 9.7% to hit almost 30 trillion by the end of 2029. It's actually a bit slower growth rate than what we predicted last year. I think we were in the double digits, 10% CAGR range. But based on what we're seeing and our expectations is interest rates are higher for longer. But we're expecting to see another difficult year of fundraising the rest of this year in 2025, but things start to pick up in 2026 and then 27, 28. So our data scientists have put that in the model, predicting that we're going to get out of this. It's going to be a new cycle, and we'll have to revisit. We revisit our forecast every year in the last quarter of the year.
Okay.
So we'll see how well we were, how on the money. What I will say we got right was which asset classes. So we continue to see, for instance, private equity. As much as we've had issues with, interest rates, the cost of financing being high, it's still a go-to and the standout asset class. We're still seeing a lot of investment there. So we've been right on that. Private equity is the largest proportion of alternative assets. It's about $5 trillion today, and we're expecting that to more than double to above $12 trillion by the end of 2029. And actually, from an AUM perspective, it's going to overtake proportionally what hedge funds take up today. Hedge funds actually projected to have a slower growth rate. So the point is that, we're going to predict, and with all the data that we collect, we can surface it and aggregate it up. And to a certain degree, and we're on track in terms of the actual levels and the thresholds for growth. It's hard to be exactly on point.
Well, there's a lot of information there. By the way, you're throwing around all these fancy terms, Shifra. So CAGR, compound annual growth rate. For those of you sitting at home wondering, what did she just call me?
Sorry about that.
No,
okay.
I'm just kidding.
No worries.
But just to clarify there, CAGR, compound annual growth rate, and that's fascinating. So 30 trillion by 2029. I was actually just watching a CNBC some guy was on there talking about alts and really same thing that you're talking about right now. It's almost like verbatim, right? Like the 60-40 split is gone. There's a growing trend into, putting a decent chunk into alternatives. Obviously depending on the season of life that you're in, it could go like way higher than, some people are going like 10, 20%. Some are going even higher than that. Into alts. And so what's causing all this growth, do you think, Shifra? I mean, like it's such a great
question. So one, certainly it's probably the highest returning part of the market right now. If you're looking at, even like private credit, which is very secure, you're looking at, 8-9% in returns. And so there are definitely, benefits there. But also, I think a big tailwind that we're seeing is the generational wealth transfer. A lot of wealth was created in the last 4 or 5 years. We saw 2021 create a lot of millionaires with all of the accumulated wealth. And actually, UBS predicted that accumulated wealth could be worth up to $83.5 trillion. And today, what's very interesting, Bain Capital is actually predicting, and other pundits are also saying there's going to be strong growth in this cohort that will be investing in alternatives. Today, they're actually underallocated to alternatives. So whereas, the institutions, they have the formula down, approximately 4 trillion of alternative assets. So 4 trillion of that 16 trillion is from the individual investor, this wealth segment of the market. But that is predicted to go up. And there's an educational opportunity. They need to learn about what these investments are, and it's going to take time. And then there's different types of vehicles that this group might invest in. They may not want as big ticket sizes, right, as the institutions.
Right.
So and they may want a little more liquidity. So we're seeing this emergence of more semi-liquid vehicles that will allow, some level of liquidation, because they need to manage their cash flows as well. In fact, one of the things we also looked at is how many times different types of firms are clicking on our data. So what we saw that family offices and they've increased the number of searches on private real estate in the last year. And so it was 45% of the searches were for private real estate, and that's up from 34% in 2023. So we're seeing increasing interest from that community.
That's interesting. So what do you think is causing that, or what's driving that interest?
I think that, the potential returns from alternatives, the potential growth, they're very well marketed, and a lot of the big names are getting deeper into alternatives, and they're hearing about it. It's becoming more of a household discussion. I want a piece of that. It's like when Bitcoin a few years ago, my hairstylist had Bitcoin. Everybody was investing. I think, though, that this isn't a short-term trend. This method of investing is something that is going to has staying power. It's going to stay for a long time. And when we look at various cohorts, take private credit or real estate credit, the reason that I see the credit high in demand also is that banks are paring back their lending. So if that creates a demand for non-traditional forms of lending. So there are definitely nuances depending on the actual asset class in question.
Coming back to what you just said about private equity and that being still one of the, despite all the turbulence or whatever like that, you still feel like that's one of the better performing alt, so to speak. So I feel like PE has like it's a very broad term, right? So like, are we talking about like PE investments into real estate specifically, broader PE? Like what do you mean by that?
When we talk about PE, we're talking about a variety of strategies, whether they be balanced strategies, buyout. So buyout strategy is a very common strategy. Venture capital, some people hobble it together, because it could be considered an early stage type of private equity, depending on how you define it.
Right.
So there's secondary private equity strategies, which are really interesting, which are quite of interest, where you can actually buy the interest, the investor interest out of an older fund. So you can buy the investment, if you will, later in the cycle. And that's also been of interest. So it's a variety of strategies. We're also seeing co-investment vehicles. But buyout, I would say, is probably a pretty dominant segment of the market. So if you're buying out, you could be taking a public company and bringing it private and buying it and purchasing the company. Or you can buy a company that's already private. Well, I'm sure you heard the news. BlackRock is acquiring Preqin. That's a buyout, right?
Yep. Yeah.
It's a transaction. It's a buy transaction. So the point is that there are a variety of methods, a variety of ways that you can actually invest. And what we're also seeing is there's a lot fewer IPOs and public listings. And so what's happening is there's this concept of private for longer. Companies are staying private longer. Yeah. There are a lot of unicorns out there and decacorns, and people are wondering when they're going to go public, but maybe they don't need to right away. I mean, there's a lot of benefits and drawbacks to being a publicly traded company.
Right. Well, I think especially, so like, let me just talk off the cuff here, right? So I think that everyone for like this like last wave of this last like decade and a half of like tech entrepreneurs, guys that wanted like to do their own startup and everything, they kind of looked at like Google and Facebook, right? Like they looked at Mark Zuckerberg, and like Zuck is like the idol, right? Well, all of a sudden when Zuck's getting deposed by Congress every week, right? Like suddenly that feels like maybe I don't want to like be, you know what I'm saying? Like I feel like now it's almost like people are seeing like there's some really heavy drawbacks to the increased scrutiny that you receive once you become such a massive public company. So do you feel like that could be part of it too?
Yeah,
it's not as sexy anymore.
The level of reporting that you have to do.
Yeah.
I mean, it definitely. I think it plays a role. Is it a distraction? Because sometimes people might view the fact that if you're a public company, then you're really subject to the whims of investors and the volatility. Whereas if you're private and you don't need the funding, you're better off, right? You can kind of run your business independent of worrying about a short-term swing to your market value.
Yeah, it's just, I think it's fascinating, right? I think that like, I went to Stanford and the guys that I went to school with, that was like right at the, that's when Y Combinator, all these things really started to pop, right? And you get all these, you get all these guys that like, that's their goal, right? Is to like build a unicorn IPO and ride off into the sunset. But I think that, I think recently there's been a shift just in terms of like what I'm seeing from just my own inner circle, right? Like people's priorities have shifted, and not saying that people don't want to build massive companies and IPO anymore, but I do kind of see what you're saying is that like maybe that there is a shift away from being as aggressive with that, going public strategy. And also like, I don't know, the IPO market the last couple of years, like I don't know, like we've seen a lot of like people, like we've seen a lot of companies not do as well as they should have, right? When they IPO.
Yeah.
Yeah. So
Absolutely.
I feel like that's part of it too.
That could be part of it as well.
Yeah.
So, there are a whole host of reasons.
Yeah.
But then a nice thing with alpha generation is you can really benefit from the growth of a company that's in the private mode by investing in these types of funds.
It's very interesting. So flipping up, you talked a little bit about family offices. I want to spend some time there because it sounds like you've got some insight into like the institutional, sector. So you've noticed that there's been a greater increase in the family office interest in terms of private real estate. What other sectors are you seeing institutional investors moving towards? Like aside from private real estate, like are there any other sectors that you see institutional?
For family offices, and generally they're bucketed in the non-institutional category. We're seeing private equity strongly as an area of interest. Private equity, as well as, I'm sorry, my dog's in the background.
It's all good.
That's okay.
What's your dog's name?
Private equity and real estate, particularly, are two asset classes that I would say we're seeing interest from currently. Some private credit as well. But private equity, I would say, is up there with private real estate.
So when we're talking about private credit, obviously, like, so this is not a debt fund, right? So when you say private credit, like lending, or
so private equity sponsor, basically, private equity sponsor will actually lend money, and there's a vehicle that you can buy into, basically, that's backed by the loans, if you will. And so it's another form of lending. Yeah. And real estate debt when you think about lending, real estate debt or real estate credit is an area that we're seeing a lot of interest. It's actually came through. Actually, the biggest fund that closed this year is a real estate credit fund of an affiliate of Goldman Sachs that closed around $7 billion. So the real estate credit, and I think putting it in that vein because of your listeners, basically this is a form of lending towards properties. And when you see the challenges that people are facing and banks are paring back their lending, it's really another form of lending that will help empower this industry, real estate credit. Yeah.
So it's like lines of credit. Maybe they're putting a lien on a property. Like let's say that there's a hotel that needs renovations. They can't. Well, this is a very common scenario, right, Shifra? In the hotel industry right now, there are a lot of owners who would have had to PIP their property or renovate, for those at home that don't know, but they would have to PIP their property during the pandemic. And so the brands kind of gave them amnesty, right? Not only that, but a lot of owners dipped into the replacement reserve account to make their mortgage payments, right? So now the brands are saying, hey, guess what? It's 2024. Your PIP was due 3 years ago. Time to renovate. And the owners are saying, my reserve account is dry and I don't have the PIP funds anymore to do the PIP. So that would be an instance of perhaps a private credit coming in and helping them with those renovations, correct?
Absolutely. Yeah. And it's actually considered a more secure. They're a lower risk strategy. I mean, they do a lot of due diligence, obviously, when they're putting these funds forth. But historically, they go for much more low risk situations here. But what we have seen, so this particular fund for Goldman Sachs is the Wall Street Real Estate Credit Partners 4. That's like I said, the largest fundraise so far this year. But real estate debt, in terms of the total market share, is pretty small today. It's around 238 billion in assets, and that pales in comparison. The total private real estate assets today is around 1.6 trillion today.
Oh, wow.
So it's a small sum, and it will likely grow over time as, debt is coming due and when debt's maturing, and they're going to need new sources of lending. If the banks can't support that, this is certainly an area that we're expecting to see growing over time.
That's interesting.
And we see a low level of non-performing loans, actually, relative still. So it's still attractive based on what we're seeing for investors to allocate to these types of debt instruments.
So it's an interesting topic that I wasn't really planning on covering with you, but since you brought it up, I've been going to these conferences now, these real estate conferences for the last couple of years. And every time I go, at least in 2022, 2023, everyone was like, it's coming. Get ready, right? And of course, the people that I'm talking to are all opportunistic. They're not saying it's coming as in I'm screwed. They're saying it's coming as in there's going to be tons of opportunities out there. There's going to be blood on the streets, and they're excited, right? And then at the beginning of this year, I was at a hotel conference, and everyone was just kind of sitting there puzzled, how are we not? What? What are the, no one really knew how to explain what it is that we're going through. Is this all going to come crashing down after the election? I have to imagine, in 10 days,
Yeah. Look, this is the private markets is still a slow moving space. When you look at, there's always a lag in where you see those markets move versus what the rest of the markets are showing.
Yeah.
In terms of, what we are seeing is a lot more properties are available for sale, heavily discounted. And so at some point, the owners of those properties, some of them are handing the keys back because they just can't pay, right?
Right.
But at some point, they're got to somehow sell.
Right.
And I've heard on another program that people are looking opportunistically, and I like how you use that word because it's also a strategy here, but they are looking at where can I get a property at a low entry point. For a while, valuations were higher than they should have been. And actually in our survey, where we survey investors a few times a year, that I think it was 65% of investors said the asset valuations for private real estate are still off. They're still higher than they need to be.
Mm-hmm.
And even in our latest survey. So as these levels come down, and then there's going to be this overwhelming pipeline that we're going to see of properties that are up for sale, and there will be buyers. We're seeing the same theme in our private equity data from the perspective, deal activity has been lower than what we've seen in a long time. Mid-market is progressing. If you look at the investment bank, earnings, they've been reasonably high because they're focusing on the mid-market. But what we're expecting to see a growing pipeline of assets, of portfolio companies, private companies that will be ready to transact in 2025. So there's going to be this overhang. When we ran some of our analysis, we saw the average asset holding period is a lot longer now than it's been for a while, where just there are a number of these funds that are not exiting their assets. And that's causing a problem where money's not being returned to investors. We're seeing it across all asset classes. So we're expecting to start to see those deal pipelines open up, and interest rates as they come down, that's going to help because the cost of financing is still too high. And, the Fed is supposed to potentially drop rates again in November, right? So as the rates shift and we normalize a bit more, we'll get to a point where, okay, we got to, GPs, fund managers, they have to return capital to the investors. They're going to have to sell.
It's interesting. Yeah. And another thing too, just in terms of like, low levels of non-performing notes, one of a previous guests, I think, brought this up, or I don't even think he brought it up in this show. We were just chatting afterwards, and he talked about the phases of the phases of just kind of like a downturn, right? And like he's like, this is kind of like the delay and pray part of it, right? Where he's like, hey, we're just going to delay it. Oh, the bank, hey, we'll just wait another 6 months. It's okay, We'll work it out, right? And then they go back and start doing Hail Marys and everything, right? So, at what point does delay and pray turn into a real problem? So it sounds like what you're saying is that at least on the institutional side, for private real estate, for example, that is held by funds. Or, is kind of like not owned like by a single entity, but rather like through like some sort of like, fund or syndication model. Like at some point they're going to have to return the capital back to the investor. So you think that like from an institutional perspective, this can only go on for so long before they have to sell. It's not just the bank. It's going to be the investors too.
It's not just the bank. And, there a lot of fund managers are using other techniques to get funding back to investors. They're borrowing money and, there's NAV financing. They're taking on loans and paying investors just to get some distributions through. And, the distributions are, so it's at some point they're going to have to start exiting a bit more. Yes.
Holy cow.
That's the whole thing right now. Yeah.
That sounds like a really horrible strategy. I mean, wow. Probably just to save face, huh? Yeah. That's crazy.
Yeah. Another strategy, though, that we've seen employed more is the secondary vehicle. So investors who want to really sell their interest, they want their money back.
Yeah.
They can sell their interest to another investor who will effectively buy the asset at a later stage. So that's why a big reason why secondaries seem to be taking off.
Interesting.
LP-led, allocator-led secondaries.
And I'm assuming
so that's a method.
Yeah, I'm assuming you could buy that interest at like a fraction of what they were originally purchased for. Interesting.
Yep.
Got it.
And that's why it slowed fundraising. Fundraising is slowed down because investors aren't getting their money back and they're not putting back into the system.
Right, because
so
they
it's
got
a whole
burned.
Cycle.
Right, they got
burned. They're not getting the money.
Interesting. So now so that's kind of contradictory to the or I would say that's working against the overall growth of the alternatives sector. So what you're saying is, despite all of this adversity, we're still expected to have like a 10% CAGR, like
we're
year
still
over year.
Gonna, because there's new investors entering the space. So there is demand, and so they're coming in, and the fund managers need to make money. They need their management fees, so they want to fundraise.
So, question for you there, right? Like, who are these new? You're talking about all the wealth that was made, like in 2021. Like, these are the new investors that.
These are some new investors, and then we're also seeing insurance companies increase their allocations as well to alternatives. So, different institution types. Some of them are increasing them again. Yeah. Last year they pared back allocations, but that shift upward among institutions. Some institutions historically didn't allocate to alternatives. Now they are as well. So not just the non-institutional, the family offices or the wealth, but also institutions are upping their alternative allocations.
Yeah. So meaning life cos, insurance companies.
Yeah.
Okay.
Endowments
Pensions.
invest as well, pension funds, absolutely.
So when we're looping all of those into the institutional bucket, you're seeing a big movement into PE is what you're saying, and private credit. Like that's where, as well as private real estate. That's really interesting. Go for it.
Yeah, but I would say with private real estate, we're seeing interest in private real estate. We haven't seen the big flows yet. Private equity, private credit, we're still seeing big flows. But just to clarify, when we ran our survey, 52% of investors said they plan to increase toward private real estate in the long term. So a lot of the sentiment that we're seeing is towards the long term, the expectation that real estate is going to improve and as an asset class, the fundamentals.
I think I can offer some insight there too, because, recently I do a lot of outreach to family offices specifically for our hotel investments. And there's a lot, when I say distressed hotels, there's a ton of interest. Everyone will raise their hand and say, yeah, I want more information, but very few are putting pen to check. And so I see what you're saying, right? Like there's an interest, but they haven't made that commitment yet. Do you think that they're all because I was actually just having this conversation with someone else, which is the opportunities are when everyone is scared, right? So when everyone is scared to write the check, that's when you should be writing the check, because that's when you make all your money, right? So when we talk about this opportunistic mentality, you would think that there would at least be some risk tolerance there, right? Understanding that like where we are in the cycle and knowing that history tends to repeat itself. At least to me, it seems like a great time to make an investment into private real estate with all the distress in the commercial sector. But what's the hesitancy? Like what's going on there?
And look, I think what happens and unfairly to real estate. So commercial real estate historically was a very big segment, right? And the most powerful segment of the real estate market, right? And it's gotten a bad rep because people are, there are a lot of office vacancies that are going up. But what we saw is that leasing rates for office space has gone up in the last year. So Amazon's telling people to come back to the office 5 days a week. BlackRock's in the office 4 days a week. And so a lot of companies are seeing that the working from home isn't really working.
Yeah.
So, you need to be in an office.
Yeah.
And, but the office real estate is only one sliver of one slice of the market. I mean, residential housing is strong. One thing I had read, mixed use properties. I think in LA, Costco is building or has a property where you have residential mixed use living properties. That's actually taking off really nicely.
Interesting.
Where you live in a development and you're right near a Costco and you're near a Shake Shack. You have a bunch of different stores. So another part of the market, data centers are really in demand.
Right.
And yes.
Yep.
So it's not this monolithic asset class. There's so many points of opportunity, and that continues to grow. In Sydney, Australia, I believe it was Macquarie. They just have a new building that they're calling the Minion. It looks like a minion. You have to Google it. And so, for Class A properties, office properties that are really state-of-the-art, highly sustainable, those are doing very well. BlackRock's new office it's at Hudson Yards. It's like a year old. Gorgeous. Unbelievable.
Yeah.
So there are aspects, and with commercial property, some are converting them. Some are buying the space and let me convert it to something else.
Yeah. I just saw a hotel conversion to multifamily deck, and it looked like an interesting project. I think that there's with the massive housing shortage in California, along with all the grants that you get for creating more affordable housing, I think it's kind of like a no-brainer in some parts of the country. Well, Shifra, we are running into time here, and I want to be respectful. I did have a couple of final questions here for you. Shifting back into real estate, you've noted before that you see senior housing as an opportunity here moving forward in terms of like a solid real estate play. Why is that? And what evidence do you have right now that supports that as an emerging trend?
Yeah. So we're seeing it's a long-term demographic shift, but the aging population is growing. The global population is going to be at 9.7 billion in 2050. The population age 70 and up is expected to rise by 140% to reach 1.1 billion. And the younger people are having less children. It seems like they've been replacing their children with pets. People are just getting pets. It's too expensive. Everything is so expensive. And so we've seen increasingly more properties, more funds that have senior housing. From a long-term perspective, retirement villages and services are becoming more attractive for development, and firms are actually repositioning assets to meet modern standards. So when I looked at our data, out of the 2,600 global private real estate funds, 106 were targeting senior housing, with the most launched in recent years. The other piece is, I'm not sure if you read the book about the 100-year life. It's called The 100-Year Life.
No, I haven't read it.
And they're talking about how people are living longer.
I know. Yeah.
I believe there's an amazing stat where a child born today has a 50% likelihood of reaching 105 years old. Crazy.
Really?
Crazy.
Wow.
Yeah. And it's going to change the whole landscape because being able to live independent living, and if you're going to have this growing senior population, and how do we sustain that? There's the divorce rate is higher. So people, if caregivers, how are you going to live independently? So, there's going to be a huge investment in tech and all these like smart robots that will help people. But seriously, it's a whole, so that shift, the senior and the long, it also changes your asset allocation decisions. When do you retire? What do you invest in? Maybe you stay in a higher equity proportion longer than you thought you would. And alternatives now. So based on the shift in the demographics, that's where we're seeing it as a long-term opportunity, a long-term play.
Yeah, I mean, that's fast. I mean, logically, it makes a lot of sense, right? And I've definitely spoken to others who are very bullish on senior housing. So I think it makes a lot of sense given everything you just said, right? Life expectancy, being a big part of that too, right? It's just like, hey, if we got more people that are living longer, then we're going to need more housing for them. So that it's perfectly logical. Well, Shifra, here at the Gould Mine, we have a tradition that every guest leave us with one final gold nugget. So I'm going to let you take it away.
Gold nugget about anything, investing?
About anything, about anything investing focus, yes.
Investing focus. I'd like to take a holistic lens, and just going back to the 100-year life. I mean, you need to think in terms of long-term what your goals are, and not necessarily be focused on the short-term moves, because those are going to they're disruptive, they're distracting. So really just thinking about life as a long-term game. That's really how we should be operating in our life, spiritually, and how we invest and how we look at the world. Yeah,
I know. I love that, and it's so hard, right? In the age of Instagram and all these social media, you're always just thinking about like what's the next best move. But I mean, you also got to be thinking about what's the best move for me when I'm 100 years old, right? So like there's that too. Shifra, this was great. I'm hoping that we can have you on sometime in the future and catch us up on the new trends and everything. I'm sure that a year from now, things are going to look different. So it would be great to have you on. But until then, thanks so much for stopping by.
Thank you.
All right.